Good morning, and thank you for joining Bracewell's webinar series, Anatomy of an IPO. I'm Annette Tripp, a partner in our financial institutions practice. As we have heard at recent conferences, such as the Strategic Opportunity Conference this past fall, some are expecting that 2017 could be a banner year for bank IPOs. In anticipation of this window of opportunity, Bracewell wants to prepare you for this opportunity by providing you with information that a bank needs to know when pursuing an IPO. With over 70 years of extensive experience working with Texas banks, Bracewell is a recognized leader in financial institutions capital markets. Over the past 10 years, our current financial institutions team has been a part of more initial public offerings for Texas bank holding companies, including Allegiance Bancshares, Veritex Holdings, Green Bancorp, Independent Bank Group, and Encore Bancshares than any other law firm. And since 2013, we have had a role in half of the IPOs that have taken place in the Southwest region of the United States. This involvement places us in a unique position to provide our clients with the proper tools to successfully guide them down the path to going public and managing public company life thereafter. The knowledge and experience of our team of attorneys runs deep in the financial sector, many of whose work in the area began before their legal career. Our panelists today are partner Jason Jean, who most recently worked on the last completed IPO in Texas, Allegiance Bancshares, representing Allegiance in the transaction. Partner Troy Harder, who prior to attending law school was a manager in the audit practice at KPMG, and partner Emily Leach, who was an investment banker before she went to law school. Cumulatively, Jason, Troy, and Emily have advised their clients in IPOs, generating billions of dollars in proceeds. I'm now going to turn the program over to Jason.
Okay, thanks, Annette. Wanted to briefly overview what we are trying to do with this presentation. Our target audience is companies planning for an IPO. We tried to find an appropriate level of detail for that audience. So that said, some of this will be elementary for some of the investment bankers and accountants that are on the line and that deal in IPOs and capital market transactions regularly. Next, I want to say that the target audience has already decided they want to do an IPO, so we will not get into all of the considerations of whether or not to pursue an IPO. We're assuming that decision has been made. Here are the topics we intend to cover with this presentation. This presentation is the first part in our series. This particular presentation will take you up to drafting your offering document. And we begin with the key service providers. Participation by several outside parties is essential to a successful IPO. Future presentations in this series will focus in detail on some of the other service providers, but this presentation will focus on the three key parties as we see them. That's the underwriters, independent accountants, and the company's legal counsel.
Hi, this is Emily Leach. I'm going to cover the underwriters section today. As most of you know on the phone, the underwriters are crucial to a successful IPO. Among other things, the underwriters help assess market conditions. They determine optimum timing for your IPO. They hone the company's valuation for the offering. They also coordinate and participate in the roadshow selling efforts, and they build the book of prospective buyers for your IPO. So at this stage, you guys are selecting the lead managing underwriters. This is just one or two firms. As the process becomes more advanced, the company and the lead underwriters are going to choose co-managers to round out the underwriting syndicate. There are a myriad of considerations in selecting underwriters, and most importantly, the lead underwriter. Some of these would be, whether your investment bankers have the industry experience, or are they familiar with your industry and, know it back and forth? Do you have a comfort level with the individual bankers with whom you would hire? The reputation of the investment banking firm and, its attention to your IPO. Also, the distribution strength, retail, institutional, or both. And then finally, whether the analysts of good reputation show a willingness to provide coverage for your bank post-IPO. Underwriters are compensated with a discount, also known as a spread. It's the amount between the price at which the underwriters purchase the shares from the company and the price at which the shares are sold to the public. This spread is a negotiated amount, and it's going to vary, but it's typically in the range of 7%. The underwriters also customarily have their expenses reimbursed by the company, other than the cost of the underwriter's legal counsel, which is typically borne by the underwriters in a successful IPO. Okay, now let's talk about the underwriting agreement. This is the agreement between the underwriters and the company, whereby the underwriters agree to purchase stock subject to certain conditions, and the parties agree on the discount or the spread that we just talked about. Banks typically have their own forms for the underwriting agreement, so oftentimes they will, Underwriters Council will produce the first draft of that, and it'll be on their bank's form. This is going to be negotiated before the first public filing of the S-1 with the SEC, although it's not going to be executed until you actually price your IPO. One of the things that's included in the underwriting agreement is a lockup agreement. So usually the form is an exhibit to the underwriting agreement. The purpose of this is that it's to avoid downward pressure on your stock price following your pricing of your IPO. The underwriters will require, and the market will expect, that the company, all directors, officers, and major shareholders will agree not to sell their shares for a period of time, which is typically 180 days following the IPO. Again, kind of the purposes of this lockup agreement, it's to provide a stable market for the stock and limit trading volatility. You're going to prevent the market from being flooded with an oversupply of stock, which could depress the price. And you also just want to make sure the insiders keep their stake in the stock. If there's going to be a large contingent of shareholders who are likely to sell their shares following the IPO and who aren't going to sign lockups, the underwriters in the company could decide to include a secondary sale component in the IPO, meaning they can include both the company and certain shareholders as sellers in the IPO. You oftentimes see this where if some of the executives of the issuer have restricted stock that's going to vest at the IPO, and they may owe some taxes on that and need some liquidity. But this does mean less proceeds to the company. The lockup agreement also is going to contain certain carve-outs. These that will include financial and estate planning purposes, also securities acquired in the open market after the IPO. There are a few exceptions on the lockup.
Hi, this is Troy Harder. I'm going to talk about the independent accountants and their role in the IPO process. The securities laws and the related rules require a company to include specified financial statements in its offering document, also known as the prospectus. Those financial statements, at least the annual ones, must be accompanied by the audit opinion of qualified independent accountants. Now, there's some view that using a large accounting firm enhances the IPO process because it will have more public company experience. However, a privately owned financial institution, prior to going public, may have used a smaller local or regional accounting firm because it was unnecessary to incur the larger fees that tend to accompany larger accounting firms. As a result, it may be necessary to change accounting firms when the decision to go public is made. And this change may be viewed as signaling to the market that in a totally legal way that an IPO is forthcoming. It is worth noting here that in the event the required financial statements are audited by more than one accountant, participation from all the applicable accountants will be required, but more on what that participation means a little bit later. Also, you will want to make sure that the individual accountants working on your audit, no matter what firm you choose, have substantial banking industry experience. Now, any audit opinion included in the prospectus must state that it was performed in accordance with PCAOB standards. If an earlier audit was not performed in compliance with PCAOB standards, a re-audit would be required, which is generally cheaper and faster than the initial audit, but still not inconsequential. In order for audited financial statements to have any value, the auditor must be independent from the company. And this is a facts and circumstances analysis, but the accounting firm, prior to engagement, will perform its diligence to make sure they are independent. In addition to the audit being conducted in accordance with PCAOB standards, the accounting firm itself must be registered and in good standing with the PCAOB. And that may disqualify some smaller accounting firms that don't have public company experience. We'll discuss more later in the presentation, but the independent accountant is integral to the due diligence process. And the independent accountant provides comfort letters to the underwriters as part of their deal documentation. But more on that to come.
Okay, thank you, Troy. So company's legal counsel acts as the hub for all the work streams related to the IPO. Company's counsel is also responsible for ensuring that the IPO planning process integrates with other corporate matters such as governance issues that we'll discuss later in this presentation. Company's counsel will also advise on the engagement of other service providers. Experienced legal counsel will be able to assist the company on the terms of engagement of each service provider necessary for a successful IPO, and will also have helpful recommendations on who to engage. Company's legal counsel will be responsible primarily for drafting the disclosure document in the IPO, which Emily alluded to earlier, is a registration statement on Form S-1 and the prospectus contained therein. The disclosures in that document are prescribed by numerous statutes and SEC rules, and it's important to have experienced counsel because they'll be able to reduce the volume of SEC comments during the SEC review process and otherwise accelerate finalization of the disclosure document. Additionally, we find that experienced counsel with significant SEC dealings will be able to anticipate SEC comments based on recent market experience and further reduce the SEC's review time. Both the SEC and the exchanges, whether that's the NYSE or NASDAQ, have a number of rules and procedures that govern interaction with them. Legal counsel will spearhead this effort and interact directly with them on the company's behalf. As important as preparations for and execution of the IPO are, preparedness to be a public company on day one is essential. This will be the subject of a future presentation in this IPO series. However, it's important to know that company's counsel is integral to ensuring that preparedness.
As I mentioned previously, the prospectus in the registration statement must contain audited annual financial statements. Now, the Jobs Act requires a minimum of 2 years audited balance sheets and statements of income and cash flows for emerging growth companies, and most banks we would presume going public would qualify as an emerging growth company. However, for marketing purposes, the underwriters often recommend having a full 3 years of audited statements of income and cash flows, which is what an issuer who's not an emerging growth company would be required to present. As I also mentioned previously, the audit opinion must be from a PCAOB registered firm who's in good standing, and the audit must be completed in accordance with PCAOB's auditing standards. Now, a question we often get is, are qualified or adverse audit opinions permitted? Qualified opinion is basically one where the audit opinion indicates that the financial statements do not satisfy the requirements of the SEC's rules, or the audit procedures applied omitted certain procedures deemed necessary by the auditor. Now, in very rare cases, a qualified opinion will be permitted, but a waiver from the SEC is required in those cases, so probably not. I wouldn't count on it. And an adverse opinion is one that states that the financial statements taken as a whole are not presented fairly in accordance with GAAP, and this is definitely not okay. But as an aside, in my experience as an auditor, I never ran across an adverse opinion. So if you do have an adverse opinion, you probably have no business going public. Along with including audited financial statements, the auditor will need to provide its consent to, number one, include the audit opinion in the prospectus, and two, identify the auditor as an expert in auditing and accounting. This consent gets filed as an exhibit to the registration statement. Now, in some cases, unaudited interim financial statements will be required. And the SEC rules provide that financial statements may only be used in a disclosure document for a specified period of time, and financial statements older than the permitted period are said to be stale, in which case the more recent financial statements must be included. In fact, the SEC won't even review a registration statement if it's filed with stale financial statements. And I know Jason has some personal experience with that.
Yeah, thanks, Ray. It's not something I like to advertise, but I once received what is referred to as a bed bug letter, which is a letter from the SEC that says the filing is so deficient that the SEC will not even review the filing. So the SEC said the document was deficient because it believed the financial statements in the filing had gone stale. After a lot of hand-wringing, we were able to explain to the SEC that they were wrong, and they agreed. Basically, the financials went stale on a weekend, and SEC rules allow you to, if a filing would otherwise occur on the weekend or a holiday, file on the next business day. So once I explained this to the SEC, really frankly what their own rules provide, both we and they moved on and acted like it never happened, happily I might add. The punchline is the SEC, in that case anyway, the punchline was the SEC commenced its review, and something, a common refrain you'll hear from us today is delay is deadly in this context where markets can be fickle and IPO windows can open and close quickly.
Now, to illustrate an example of the staleness rules, assume your company with a calendar year end files its S1 today. That S-1 would be required to include audited annual financial statements for 2015 and 14, and may include 2013 for marketing purposes, like I mentioned before. It would also be required to include unaudited third quarter financial statements. Those Q3 financial statements will go stale on February 14th, which means if we're not finished with the SEC review process by then, which will almost certainly be the case, we'll have to file an amendment to the S-1 to include 2016 year-end financial statements. The interim period financials won't be audited by the independent accountant, but they will need to do what's called a SAS 100 review. But all you need to know about that is that the review will have to be taken into account when determining the timing of the IPO. It's also important to note that interim period financials require the comparative period from the prior year. And this is where we see many new issuers struggle, since they may not have had quarterly financials prepared prior to deciding to go public. The disclosure rules require that selected financial data be included in the prospectus. And for emerging growth companies, selected financial data is not required for any periods prior to the earliest audited period in the prospectus. However, for marketing purposes, again, a full 5 years of selected financial data is usually recommended by the underwriters. Although the full 5 years don't have to be audited, the underwriters and their legal counsel will expect accounting comfort for those numbers. And like I mentioned before, if you've got recently engaged a larger accounting firm in anticipation of your IPO, this means that the current as well as the prior auditor may need to play a role in the comfort letter process. So the comfort letter from the outside accountants is an important aspect of the underwriter's due diligence. In the comfort letter, the outside accountants confirm the financial statements in the prospectus, as well as information in the prospectus that's derived from those statements and certain other financial information contained in the prospectus. It's important to confirm early and often with the outside accountants that they are not aware of any development that would prevent them from being able to deliver a customary comfort letter at pricing and closing. And the underwriters and their counsel will be very focused on this. We'll discuss comfort letters in more detail in a later presentation in this series.
Okay, thanks, Troy. More on financial statements. So acquisitions and the prospects of acquisitions are constant for community banks. The key here is you don't need to put acquisitions on hold while you're pursuing an IPO. However, there are several key considerations that you want to keep in mind. The SEC has rules on when the acquisition of a business, which is a defined term, requires audited financial statements of the target and pro forma financial information. In the community bank context, it is usually pretty intuitive when an acquisition of a business occurs. However, the SEC may also consider a branch acquisition to be an acquisition of a business if historical revenue producing activity is reasonably traceable to the management or customer base of those acquired branches, and that activity will remain generally the same following the acquisition. Depending on the significance of the target relative to the company, the IPO disclosure document may need to include audited financial statements of the target. There are 3 tests used to measure significance. If the threshold in any of these 3 tests is exceeded, audited financial statements of the target will be required. We have an asset test, an investment test, and an income test. Depending on how the calculations come out, anywhere from no audited financial statements of the target to 2 years of audited financial statements of the target may be required. One of the keys here is the performance of these calculations is complicated, and we find that it's best to have outside accountants consulted, because there are numerous rules and interpretive guidance that are involved in those calculations. Additionally, multiple acquisitions that are individually insignificant may nonetheless require financial statements if they exceed certain significance measures on an aggregate basis. If audited financial statements of the target must be included in the disclosure document, the accountant that performed the audit and whose audit opinion will be included must consent to the inclusion of its opinion. Target financial statements do not need to be audited by a PCAOB registered firm, and they do not need to be performed in accordance with PCAOB standards. So the takeaway there as you're looking at potential acquisitions is, so long as they have audited financials It does not matter whether those financials comply with PCAOB requirements. The other key here is to plan ahead in your definitive agreement. If the acquisition will be pending at the time of the IPO, you want to ensure that the merger or purchase agreement contains covenants of the target to assist in providing the information that's necessary for inclusion in your disclosure document. Pro forma financial information shows what the company and the target on a combined basis would have looked like for a specified period and on a specified date. Pro forma financial information is required if a significant acquisition has occurred or is probable since the date of the last audited balance sheet of the company that's otherwise included in the disclosure document. And here, significance is measured in the same manner we described moments ago. If required to be included, you would include a balance sheet as of the most recent required date and an income statement for the most recently completed year and any required interim period. The timing of an acquisition disclosure in a disclosure document is very much a facts and circumstance analysis. However, a letter of intent or term sheet alone is generally not sufficient to require disclosure. Usually, the execution of a definitive merger or purchase agreement is the moment when we would advise our client that this disclosure is appropriate. The underwriters and their analysts will require financial projections to assist in valuing the company. These projections will be developed by management of the company, and you can expect that the underwriters will scrutinize those closely and test assumptions on which they are based. These projections will not be included in the disclosure document and will not be shared with prospective investors. And I'm going to turn it over to Troy here. If there's anything more fascinating than financial statements, it's internal controls and procedures. Yeah. Troy, take it away.
I drew the short straw there. All right. It's no secret that being a public company comes with onerous disclosure requirements that mandate controls for disclosure and financial reporting to ensure that those disclosures are accurate. And this process typically isn't surprising to our banking clients who are already required to file call reports and are subject to periodic regulatory review, particularly financial institutions with more than $1 billion in assets who are already subject to fiducia because they're already required to have significant controls in place. That said, disclosures as a public company do come with additional avenues for potential liability to the company and its officers. Disclosure controls and procedures is defined generally as controls and procedures that are designed to ensure that information required to be disclosed in periodic reports with the SEC is communicated to management and reported within specified time periods. And the CEO and CFO of the company must evaluate the effectiveness of these disclosure controls and procedures on a quarterly basis. Internal control over financial reporting, which is a mouthful, so I might call it ICFR, is defined generally as a process designed by or under the supervision of the CEO and CFO to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements for external purposes in accordance with GAAP. Beginning with the company's second 10-K after it goes public, the CEO and CFO must evaluate the effectiveness of the company's ICFR on an annual basis and include a report in its 10-K. Additionally, on a quarterly basis, the CEO and CFO must evaluate whether there's been any change that has materially affected or is reasonably likely to materially affect the company's ICFR. And then once the company ceases to be an emerging growth company, the outside auditors will be required to attest management's report on ICFR every year. Both the CEO and CFO will also have to sign and file certifications with the SEC regarding the foregoing on a quarterly basis, and that carries with them personal liability. While all these reports and certifications are required after the IPO, it's time-consuming and costly to develop a system of internal controls, so we often recommend that a company engage an outside accounting firm, which would be one that's not performing the audit, to ensure that the company has adequate controls and procedures in place prior to the IPO.
Okay, switching gears a little bit to maybe a more fun topic, corporate governance. SEC rules and stock exchange listing rules prescribe standards for board composition, and they mandate certain tasks to be carried out by committees of the board of directors. The New York Stock Exchange listing rules differ in certain respects from the NASDAQ listing rules, but we're going to kind of cover the highlights there. First, let's talk about board independence and composition. Typically, newly public companies have between 5 and 12 directors. Community banks tend to be on the high end of this range because of the nature of community banking. The New York Stock Exchange and NASDAQ listing rules both require that a majority of the company's board be comprised of independent directors. The definition of independence varies with respect to the applicable exchange and whether or not the candidate will serve on the company's audit or compensation committee. Determining whether a particular director meets the applicable independence standard is typically a fact-intensive analysis, but the basic point is that they have had no material relationship with the company. Notably, this does extend kind of from officers and directors to their family members, transactions with the company, audit relations, etc. In many ways, determining the post-IPO board composition can be one of the most difficult decisions the company has to make in the IPO. In some cases, a director who has contributed to the growth of the IPO may not be a good choice as a public director. Some ways to mitigate the impact of the relationships is to offer advisory director positions with the holding company or retain the individual as a director of the bank. Obviously, a lot of great care is put into board composition. Diversity is a very hot topic in the market right now. You want to ensure that you have a diverse board with diverse backgrounds, skills, ages, et cetera, that provides different perspectives and ultimately helps you run your bank in a more diverse way. Let's talk about the mandatory committees of the board. So typically you have 3 committees: audit committee, comp committee, and maybe a nominating corporate governance committee. A listed company's audit, compensation, and nomination committees must consist entirely of independent directors. Both the New York Stock Exchange and NASDAQ require a minimum of 3 persons on the audit committee, which the audit committee selects and oversees the work of the company's auditors. Further, the audit committee must have a member that qualifies as an audit committee financial expert, which is defined by rule. NASDAQ-listed companies do not need to have a nominating committee as such, as so long as nomination decisions are made only by independent directors. However, it's very customary to have one. These committees are committees of the public holding company and should not be confused with committees of the actual bank. Some other banks have pricing committees for the IPO. While it's not required, many companies choose to appoint an IPO pricing committee, usually comprising a subset of the company's CEO, CFO, and typically at least one independent member of the board who has experience in IPOs, to meet with the lead underwriter to approve the terms of the IPO and set the price of the shares that will be offered to the public. Switching to charter and bylaw amendments. So many times there are provisions in a private charter that are not appropriate for a public company. One example is preemptive rights. Additionally, there are provisions that may be appropriate for inclusion in a public company charter that would not appear in a private company charter. Examples of these would be classified boards, exclusive venue provisions, maybe proxy access provisions, blank check preferred stock, etc. Finally, there may be charter amendments that are necessary to facilitate the IPO itself. For example, you need to look at your number of authorized shares. You may need to increase that number or provide for a stock split or reverse stock split in connection with your IPO. Also take into consideration the views of institutional proxy advisor recommendations, such as ISS and Glass Lewis. Be mindful of their firm's recommendations when determining your charter amendments. Charters are viewed unfavorably by institutional proxy advisor firms, and if they're viewed unfavorably, that may lead to them making adverse recommendations at a future shareholder meeting. Also notably, any charter amendments will require both board and shareholder approval. This could create timing issues, so you need to coordinate a meeting in advance of your IPO, and it could also create disclosure issues, possibly signaling to your shareholder base that IPO preparations are underway. Always get underwriter input on charter changes, as some changes may negatively impact marketability. You're also, in connection with the IPO, going to need to adopt new policies and charters. They're going to be required under statutes and stock exchange and SEC rules. The first one's a code of ethics. So NASDAQ and the New York Stock Exchange listed companies are required to have a code of ethics for directors, officers, and employees. Code of ethics means written standards reasonably designed to deter wrongdoing and to promote honest and ethical conduct, including matters regarding actual or apparent conflicts of interest between personal and professional relationships, Also, full, fair, accurate, timely, and understandable public disclosure, compliance with applicable laws and regulations, prompt internal reporting of violations, and accountability for adherence to the Code of Ethics. And the code's got to be made available on the company's website. You're also going to have committee charters for each of your 3 standing committees of the board. They're going to have a written charter, and you will post that on the company's website. Another one is an insider trading policy. This policy is designed to protect insiders who have access to material, non-public information from inadvertent violation of securities laws. This policy is not required, but it's highly recommended and standard in the market. Corporate governance guidelines is another one. New York Stock Exchange listed companies are required to have corporate governance guidelines, and such guidelines are highly recommended for NASDAQ listed companies. The NYC listed companies must post these guidelines to their website, and the same kind of goes for the NASDAQ companies. One other thing you need to consider is D&O insurance. So the scope of liability for directors and officers of a public company is understandably greater than that of your directors and officers now. You'll want to ensure that you have adequate D&O insurance in place when the IPO prices.
Okay, thank you, Emily. Equity incentive plans. It's important to assess whether you have the appropriate equity incentive structure in place. Many equity incentive plans for private companies lack some of the features and provisions that you would expect to see in a public company plan. Therefore, it's important to have experienced employee benefit counsel review your plan, and that review may result in the need for amendments. Regardless of whether the plan needs structural amendments, you will likely want to allocate additional shares for issuance under the plan, which requires a stockholder vote. It's best to obtain this vote, if at all possible, before the company becomes public. Doing so after requires more onerous disclosure and will involve a public stockholder base that may be less receptive than your existing stockholder base. Now, the market will have certain expectations about what your plan, most importantly, how much dilution stockholders could experience if all the shares that are subject to the plan are issued. We recommend engaging compensation consultants and discussing this point with your underwriters, because they will have a view. Too many, or even in some cases too few shares subject to the plan could harm marketing efforts during the IPO. Based on our recent experience, we tend to see share allocations in plans in the 10 to 15% range. Some recent Texas bank examples, Veritex was at 15%, Green Bank 15.5%, Allegiance 11.4%, and Independent Bank was 6.7%. As a public company, you will no longer be able to rely on the exemptions from registrations that you've historically relied on to issue securities to employees as incentive compensation. Instead, those offerings will be registered registered on a Form S-8, which we'll discuss at a later presentation in this series.
All right, thanks, Jason. Now I'm going to talk about due diligence, and you've heard us mention due diligence a few times already, and you may be familiar if you're management of a bank with diligence in the M&A context, but unlike in an M&A transaction where due diligence is intended to uncover potential liabilities or other risk exposure, diligence in an IPO context has 3 main functions. Number 1, assemble the information required to be in the offering document. 2, ensure that no information required by the SEC rules or that may be considered material to the offering is omitted from the offering document. And lastly, confirm the accuracy of all factual information disclosed in the offering document. And due diligence is additionally significant to the underwriters because it affords them certain defenses if securities litigation arises in connection with the IPO, what's referred to commonly as the due diligence defense. And it also helps the underwriters in the valuation and marketing of the company's securities. This is all very time-consuming and labor-intensive. Due diligence requires the location and scanning of many documents. We recommend that companies have a staff who are aware of the IPO that are dedicated to responding to due diligence requests, because it's going to take a lot of their time. And the numerous documents that are produced for the diligence review should be consolidated in a single place that's accessible remotely by all members of the working group. And these days, typically done via a virtual data room, and all the financial printers have software that's available that allows for construction and maintenance of these virtual data rooms. The documentary due diligence generally kicks off with a lengthy due diligence request list provided by the underwriters or really their counsel. The request will be extensive and will take several weeks to respond to, and multiple supplemental diligence request lists are common as the underwriters and their legal counsel perform their review of the documents provided. In addition, all the directors and officers will be required to complete a D&O questionnaire, and the length of this questionnaire can be surprising for many directors who haven't seen them before. But these D&O questionnaires are an important piece of the due diligence puzzle. Additionally, these questionnaires are vital in assessing director independence and ensuring that the company complies with the disclosure requirements in the prospectus. In addition to documentary diligence, the underwriters will hold in-person or telephonic diligence sessions. One or more meetings will be held with key management and departments, including the credit department for a bank. The questions are prepared by the underwriters with follow-up questions occurring during the course of the meetings. And the underwriters will also hold meetings with the auditors who audited the financial statements appearing in the prospectus. The company won't be present at these sessions. Then at the closing of the IPO, both sets of counsel, both the companies and the underwriters, will be required to deliver to the underwriters a legal opinion that essentially says, based on the information they've reviewed and meetings they've attended, the prospectus does not contain an untrue statement of a material fact or omit to state a material fact necessary to make the statements therein, in the light of the circumstances under which they were made, not misleading. And due diligence is the underpinning of these opinions.
Okay, so now let's talk a little bit about publicity surrounding your IPO. The IPO is obviously an exciting time, and company is understandably excited about this process and kind of wants to share it. But there are some very real rules that you need to be aware of and kind of take care in all your communications surrounding your time of your IPO. The first one's called gun jumping. That term is used to describe a company that gets an impermissible head start on efforts to market the IPO. Let's go back a little bit. The basic tenet of securities laws is that an offering of securities must be either registered with the SEC or exempt from registration. The most common exemptions from registration that financial institutions clients have are typically private placement exemptions, intrastate or merger exemptions, and employee compensation benefit plan exemptions. Because all of the most likely exemptions from registration prohibit generally publicizing the offering, statements about the company or the offering should be very limited. Be cautious regarding actions that may be viewed, with the benefit of hindsight, as conditioning the market for the company's securities. What that means is influencing investor sentiment about the company before the investor has been given the opportunity to receive and review the prospectus mandated by the SEC's rules. Although the Jobs Act liberalized private placements and use of general solicitations, this does not apply in the IPO context. The most common penalty for gun jumping is an SEC-imposed cooling-off period. That's what Jason mentions. You have to, the cooling off period would require the company to slow down its process. It'd have to sit on the sidelines for a while. This can be disastrous as equity capital markets can be fickle and IPO windows can open and close rapidly. As Jason said, delay can be deadly. One of the highest profile examples of this was one of the officers of Google did an interview with Playboy, and it got published kind of right before the IPO. It was a huge embarrassment for them. They had a cooling off period. They also had to attach the Playboy article to their IPO prospectus and include risk factors. And when you attach an article like that to your IPO prospectus, it also attaches liability associated with any of the statements made. So, it's embarrassing. There is true liability. You'd absolutely want to avoid it. Just one note there, filings by emerging growth companies, when you confidentially submit your S-1, which we may go into further detail on another presentation, but that does not count as the filing. So when does all this start? Usually you start what we call the quiet period at the organizational meeting for your IPO. It's when you formally kick off your IPO process. Once that quiet period starts, what can you do? You basically can do what you normally do. You can issue press releases, you can do interviews, you can post information on your website, you can present at investor conferences, etc. But, and this is a big but, don't mention the IPO. The SEC's developed a safe harbor for communications made more than 30 days in advance of a public filing of the S-1. So like I said, before 30 days, continue business as usual, but no mention of the IPO. Once you get into a 30-day window before you're going to file your S-1 publicly with the SEC, you get into what we kind of call the quieter period. The safe harbor there, the SEC allows you during that 30-day period to communicate regularly released factual information without any references to the IPO offering. In practice, this is of somewhat limited use because companies going public, private companies typically haven't had much in the way of past practice. They haven't been public before, so there's kind of not a lot to lean on there, but do be aware that in the 30 days prior to the public filing of the S-1, things get even more highly scrutinized. Also, watch out for investor conferences. They can be a trap for the unsuspecting. You really need to consult with legal counsel before you present at any of these conferences. Make sure you have a prepared script and are, appropriately prepared to answer any questions that they may have, even about the IPO. One of the things we wanted to mention is testing the waters. So the Jobs Act provided a specific exemption for oral or written communications to institutional accredited investors and qualified institutional buyers during the quiet period. These communications, if they occur, will occur under the guidance of the underwriters. The audience very much matters in these conversations. The communications can be helpful in honing the story and gauging interest in the company's IPO. No one wants to file an IPO and have it fail. These conversations, these testing the waters conversations, typically happen a few weeks before launch, and they're crucial in helping determine the IPO price range as well. We're going to talk later at a later presentation about what is permitted once the disclosure document has been publicly filed, but we'll kind of stop with the publicity there. One thing we also want to make sure you do is to review your websites. For the reasons we've just described, the company's website needs to be examined for impermissible statements that may be deemed to condition the market. A trained eye should perform a review of your website. You also can't do a major revamping of your website during the IPO process. So, make sure before you even kind of kick off your IPO org meeting that, you've looked at your website, you've revamped it if you're going to make any changes, because you certainly will not be permitted to do that kind of once you start the IPO process. Also, you need to examine any pre-IPO stock issuances by the company, because the offering of securities in an IPO necessarily involves public solicitations. This potentially jeopardizes prior unregistered offerings by the company, which oftentimes rely on private placement exemptions and may be subject to integration issues with your IPO. By rule, the SEC has adopted a 6-month safe harbor. Therefore, particular attention needs to be paid to offering securities within 6 months prior to the launch of the IPO. The SEC disclosure document must also disclose all offerings and the price, therefore, of securities issued during the 3 years prior to the IPO. The SEC will scrutinize these issuances and the claimed exemptions in their review of your S-1.
Okay, thanks, Emily. Costs and expenses. So this slide speaks for itself. As you can see, the process is expensive, but if you're looking for a silver lining, most of these costs can be capitalized. There's just simply a lot of work and expertise that go into a successful IPO, and here are several recent examples in our region. Not reflected on this chart are the underwriting discount and commission, which we mentioned earlier in this presentation. So that concludes this presentation. Our next presentation will focus on the next stage in the IPO lifecycle, which is preparation of the offering document and various other pre-launch IPO matters. And with that, okay, so we have a few questions that have been submitted. We've got about 12 minutes, so Annette is going to assemble those questions, and while she does that, I'll just make a couple of statements on this slide here. I'd like to say that if you'd like to speak with any of the presenters here, their contact information is on this slide, and we're of course happy to visit with you and talk about any issues in greater detail. So Annette, we have a few questions that have come in.
Sure. Let's start with this one, Jason, and it's probably for you. We have a robust committee structure at the bank. Is that sufficient?
Well, so know to start briefly, and then I'll say to this point in time, the focus of operations has been the bank, right? We find that to be the case always with our financial institution clients. Oftentimes the holding company is even an afterthought. However, once you do the IPO, the holding company will be the public entity. It will have filing obligations, and its existence will take on increased significance. So what we described earlier, what Emily described earlier about committee structures, those apply to the holding company, not the bank, and you want to make sure that your holding company committees comport with law.
Okay. What does the IPO market look like for 2017?
Yeah, I'll take that one. So the answer is, that's really not a lawyer question. We can say that there certainly seems to be enthusiasm, and the equity markets seem to be receptive as of today. But as we said at least 3 times previously today, things can change rapidly. So what I would say is it's important to consult with your investment bankers. They have the pulse of the market and will have a much better market perspective. Also, it's important to keep in mind that an IPO has a long lead time. You may start the process today when the markets are favorable, but then not be in a position to launch it until later when the markets are less receptive. So if you're an institution that's serious about an IPO, there is real value in doing the legwork now so that you can be ready if and when markets are optimal in the future.
Okay. I have a sophisticated board, but none of them have served on a public company board. What can I do to prepare my board members?
I'll take that. Being on a public company board is very different from a private company board. As a private bank, you likely have filled your board with people who know a lot about the banking industry, but not necessarily about being a public company. I know at Bracewell, we always provide our newly public company clients with what we call a director's primer. It lays out the obligations and requirements in a fairly easy format. And I know there's also some trade associations. There's the NACD, the National Association of Corporate Directors. They have some excellent programs, and actually Emily is a director on that, right?
Oh, that's right, yes. So I represent Bracewell on the board of the Tri-Cities chapter of the NACD. It is a wonderful organization. It's made up of extremely high caliber directors with excellent resources, both online, and they will offer to come speak to, your company or your new board and do some onboarding or tips and that kind of thing. They also have just, a phenomenal amount of resources online that, I would be happy to try to, get to you if you'd like that. Please reach out to me. They also can help with director searches. They're not necessarily an executive director search firm, but in an informal way, they have a lot of, they're very plugged into the director community and might be helpful on that front. So if you have any questions about the NACD, please reach out to me.
All right. My bank has recently switched auditors to make sure our options are open. What has your general experience been with auditors working together?
Yeah, I'll venture a guess at that. So in our experience, all of these parties are professionals, and they all play nice in the sandbox. Additionally, there's just not much overlap. Each auditor will address the periods it audited, so you don't tend to see them bumping up against each other much during the IPO process. And I'm just kind of looking around the room and seeing, a general nod of consensus. So this consensus here seems to be that's usually not a problem.
How long does the process take?
I'll take that one. It depends is the answer. Typically, I would say from the outset of your IPO org meeting till the pricing, it's usually around 4 to 6 months. You got a lot of variables in there. You've got market conditions. As Jason mentioned, the IPO windows kind of open and close, so you got to be aware of those, and that could influence how long this entire process would take. Also, you could have auditing issues, like we talked about. There's certain financial statement requirements, and those, if you have to kind of get your ducks in a row on either prior acquisitions or just your own, that could cause delays. Another component that you can't control is the SEC. So you're going to go through a review and comment process with them on your S-1 document, and that can take some time. It also depends on the degree of their questions. If they're asking you a lot of complex accounting questions and you're going to have to handle those in your S-1, the process can take a longer time. But I think the general answer is around 4 to 6 months.
Okay. What kinds of things could be showstoppers?
I'll take that. Of course, the biggest showstopper is going to be market conditions, and the underwriters will counsel the company as to when is the right time to go, and whether there is anything that would be a showstopper in terms of market conditions. But setting that aside, I would say that accounting issues tend to be the biggest showstoppers. We're taking a company that has previously been private and not had oftentimes PCAOB required audits performed, so that often slows down the process to get that done. That there's also just making sure that the financial statements are prepared on a timely basis, which hasn't been, or the requirements for that are accelerated in the public company context.
When is the best time to kick off an IPO?
Right now. No, in all seriousness, I don't know that there's a best time to kick off an IPO, setting aside what Troy mentioned, market conditions. However, it is the case that generally you want to avoid being on the road and marketing your stock the last couple weeks of August or during the first or the last few weeks in December. Those tend to be slow weeks when it's hard to get the attention of investors. Now, this is another question, as Troy mentioned, that really falls within the underwriter's bailiwick. They will have the pulse of market conditions and be able to advise when it's best to announce to the world that you're taking this next big step. And with that, so we have a few more minutes. I don't see any more questions in the queue. If we missed you, we do apologize, and we will follow up with those questions, any questions that we missed. That concludes the presentation with a few minutes to spare. Thank you for your time and attention to this. And again, we're happy to visit with anybody that has additional questions they'd like to serve up. Thank you.